Hey everyone, welcome back to the channel. Today, we're diving deep into the world of investing by ranking all major asset classes based on their risk level. We'll go from the wild, high-risk speculative assets all the way down to the safest, most stable investments. So whether you're a beginner looking to start your investment journey or a seasoned pro refining your portfolio, you're in the right place. If you find this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update on smart investing. Now, let's get started. Let's start at the top with the highest risk investments. These are the assets that can make you incredibly rich or wipe you out just as fast. They are extremely volatile, often speculative, and require a strong stomach. First up, we have cryptocurrencies. Now, crypto is one of the most exciting asset classes out there. Bitcoin, Ethereum, and altcoins have made millionaires overnight, but they've also caused massive crashes. Bitcoin alone has seen drops of more than 50% in a matter of months, and regulatory uncertainty makes things even riskier. You could see your investment double in a week, or lose half of it just as fast. If you're in crypto, you need to be prepared for wild price swings and be in it for the long haul. Next, we have venture capital and startup investments. Investing in startups sounds glamorous, getting in early on the next big tech giant, but the reality is harsh. About 90% of startups fail, and even if you invest in a promising company, it could take years before you see any returns. If you don't have the capital and patience to wait, this is a risky game to play. Then there are penny stocks. These are stocks that trade for under $5, and they're known for their massive potential gains and equally massive losses. Penny stocks are often highly speculative and prone to manipulation. Because they have low liquidity, they can skyrocket in price in a single day, but they can just as easily collapse. It's a high-stakes gamble. Moving on to commodity futures. This includes oil, gold, natural gas, and agricultural products like wheat and coffee. The catch: these prices fluctuate based on global events, things like war, inflation, supply chain disruptions, and even the weather. Futures contracts can be highly leveraged, meaning you could make a fortune, or lose it all if the market moves against you. If you don't understand leverage, stay away. Next is Forex trading, foreign exchange trading. This is where you trade currency pairs, betting on the value of one currency against another. It's a fast-moving market with extremely high leverage. A small price movement can completely wipe out an account if you're not careful. Plus, currency markets are influenced by government policies, economic data, and central bank decisions. Unless you're an expert, Forex can be a dangerous place to invest. Then we have junk bonds, also known as high-yield bonds. These bonds offer higher interest rates than regular bonds, but that's because the companies issuing them are at a much greater risk of default. You might get a 7 or 8% return on a junk bond, but if the company collapses, you might end up with nothing. Finally, we have leveraged ETFs and derivatives, including options, futures, CFDs, and swaps. These are tools that can amplify your gains, but they also magnify your losses. For example, a 3 times leveraged ETF moves 3 times the market, which means if the market drops 5%, you're losing 15%. Derivatives can be extremely risky, and they're not something you should jump into without serious knowledge. Now let's shift to moderate risk assets. These investments still carry risk, but they offer more balance between growth and stability. First up, growth stocks. These are companies in fast-growing industries, like tech and biotech. Think companies like Tesla, Amazon, and Nvidia. They have enormous growth potential, but they're also highly volatile. A bad earnings report or a market crash can send them tumbling. Then we have real estate investments. Whether you're buying rental properties or investing in REITs, real estate can be a fantastic wealth-building tool. But it's not risk-free. Market cycles, economic downturns, and high interest rates can impact property values and rental income. Plus, managing rental properties comes with its own headaches: tenants, maintenance, and unexpected expenses. Next, corporate bonds, specifically investment-grade corporate bonds. These are issued by financially stable companies, so they carry lower risk than stocks, but they're still affected by interest rates and economic downturns. If a company faces financial trouble, bondholders may get hit. Then we have blue-chip stocks. These are massive, well-established companies like Apple, Microsoft, and Johnson & Johnson. They provide steady growth and often pay dividends. They're more stable than small companies, but they're still affected by market downturns. Another moderate risk investment is private equity and hedge funds. These funds offer access to unique opportunities, but they often require high minimum investments, charge high fees, and have long lockup periods. You're putting your money in for years, and there's no guarantee of returns. Finally, we have commodity ETFs. These let you invest in a basket of commodities rather than picking just one. They're less risky than trading individual commodities, but still volatile depending on global trends. Now let's move to the safest category, low-risk assets. These investments prioritize stability and capital preservation over high returns. First, government bonds. U.S. Treasuries, municipal bonds, and TIPS are some of the safest investments. They provide guaranteed interest payments and have virtually no default risk. However, they're sensitive to inflation and interest rate changes. Then there are certificates of deposit and fixed deposits. These offer fixed returns with virtually no risk, but your money is locked up for a set period. If you need to access it early, you could face penalties. Next, money market funds. These invest in short-term, high-quality debt securities. They're highly liquid and very stable but offer very low returns, just slightly better than a savings account. Finally, we have savings accounts and treasury bills. These are the ultimate low-risk options. You won't lose money, but inflation can erode your purchasing power over time. If you need immediate access to your cash, this is where you park it. So, what's the best investment strategy? Well, that depends on your risk tolerance, time horizon, and financial goals. If you're young and can handle volatility, higher risk assets like growth stocks, real estate, and even crypto might be worth considering. But if you're nearing retirement or want steady returns, a mix of blue chip stocks, bonds, and safer investments is the way to go. Now, I want to hear from you. What's your investing style? Are you a risk taker, or do you prefer a steady approach? Drop a comment below and let's discuss. If you found this video helpful, smash that like button and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one.